Hello, welcome to Capital Sensei. Today, we're going to dive into one of the most spectacular and frankly terrifying stories in modern financial history. We're talking about the rise and catastrophic fall of a hedge fund called long-term capital management. As brilliantly chronicled in Roger Lowenstein's book, When Genius Failed. This isn't just a story about losing money. It's a story about how a team of the smartest people on the planet, including Nobel Prize winners, built a financial machine they believed was perfect, only to see it spin out of control and nearly bring the entire global economy down with it. We try to answer as many questions as we can in the comments section whenever a new video goes live. The story of long-term capital management is complex and raises a lot of questions about risk and the nature of our financial system. So please, share your doubts, your thoughts, or even your own experiences with investments that didn't go as planned. Your stories create a community where we can all learn from each other. To understand the story of long-term capital management, or LTCM as we'll call it, you first need to understand the team behind it. This wasn't just a group of sharp Wall Street traders. This was, on paper, the financial equivalent of the 1992 Olympic Dream Team. At the helm was John Meriwether, a legendary figure from the investment bank Salomon Brothers. He was the undisputed king of bond trading, a quiet but intensely competitive man who had assembled a team of traders so profitable they were famously nicknamed the Big Swinging Dicks in another famous book, Liar's Poker. But Meriwether didn't just bring traders. He brought in the heavy artillery of academia. His partners included two men who were, quite literally, financial royalty: Myron and Robert Merton. If you've ever taken a finance class, you know these names. Just a year before the fund's collapse, these two would win the Nobel Prize in economics for their groundbreaking work in pricing financial derivatives. Their work, especially the famous Black-Scholes model, gave the world a mathematical formula to determine the value of options. Think about how revolutionary that is. It was like they had found a hidden blueprint for the market, a way to use higher mathematics to find certainty and logic in what seemed like chaos. To investors, having these two on board was like having Isaac Newton design your catapult. Their presence gave LTCM an aura of intellectual invincibility. It suggested that their strategies weren't just smart guesses, they were scientifically proven truths. This collection of brainpower was unprecedented, and it attracted over $1 billion in initial investment. An unheard-of sum at the time. So what was this genius strategy that was going to print money? The core idea was something called arbitrage. Now, arbitrage, in its purest form, is the closest thing to a free lunch in finance. It's about finding tiny, temporary mispricings between two or more similar assets and exploiting them. Imagine you're at a farmer's market and you see two stalls side by side selling the exact same type of apple. One stall sells them for $1, the other for $1.01. You could, in theory, buy the cheaper apple and immediately sell it to someone at the other stall's price, pocketing that 1 cent profit with zero risk. LTCM applied this same logic to the global bond market, but on a mind-boggling scale. They would find, for example, two different types of Italian government bonds that were nearly identical, but were trading at slightly different prices. Their models told them that eventually, the prices of these two bonds had to converge, meaning the price gap would close. They would bet on this convergence. They'd buy the cheaper bond and sell the more expensive one short. When the prices came together, they'd make a tiny profit on the spread. Here's the catch, and it's a big one. These price differences were microscopic, often just a few hundredths of a percent. That 1 cent profit on an apple is nice, but it won't make you rich. To turn these tiny crumbs of profit into a feast, LTCM needed 2 ingredients: an enormous amount of capital and an even more enormous amount of borrowed money. This borrowing is called leverage. Leverage is a concept that's crucial to understand. Think of it like using a long crowbar to lift a massive boulder. With just your own strength, you can't budge it. But with the crowbar, you can amplify your strength and move it easily. In finance, leverage means using a small amount of your own money, your capital, to control a much larger amount of assets. LTCM was the master of leverage. For every $1 of their own money, they would borrow $25, $30, sometimes even more than $50 from big banks. This incredible leverage had a magical effect. It turned a tiny 0.01% profit into a much more respectable 0.25% or 0.5% profit on their own capital. And when you do thousands of these trades all day, every day, with billions of dollars, those profits add up to staggering sums. But leverage is a wickedly double-edged sword. Just as it magnifies your gains, it magnifies your losses with the exact same power. If that boulder slips off your crowbar, it doesn't just fall, it crashes down with amplified force. For the first few years, everything went perfectly. The machine worked just as the geniuses designed it. In its first full year, 1995, LTCM returned an astonishing 43% after their hefty fees. The next year, 1996, they returned 41%. These weren't just good returns, they were God tier. They were doubling their investors' savings, money every 2 years. Wall Street was in awe. Pension funds, university endowments, and wealthy individuals were begging to get in. The fund operated from a secluded, high-tech office in Greenwich, Connecticut, far from the noise of Wall Street. They were notoriously secretive. They rarely, if ever, told their investors what their specific strategies were. The message was clear. You don't need to know. We are the geniuses. We have the models. Just give us your money and watch it grow. This secrecy fed into an incredible sense of arrogance and hubris. The partners believed they had transcended risk. They saw the market not as a messy, emotional collection of human beings, but as a rational system that would ultimately obey the elegant laws of their mathematics. They had built complex risk models based on decades of historical market data. These models told them with scientific certainty what the probability of any given event was. They could calculate, for instance, that the chances of losing a certain amount of money in a single day were so infinitesimally small that it would only happen once in 10,000 years. They were convinced they had built the perfect, unsinkable ship. But they were sailing in an ocean full of icebergs that weren't on their old maps. The first sign of trouble appeared in 1997 with the Asian financial crisis. Economies in places like Thailand, Indonesia, and South Korea, which had been booming, suddenly collapsed. Currencies plunged, and markets went into a tailspin. Now, according to LTCM's models, this should have been good for them. In a crisis, investors typically engage in a flight to quality. They sell risky assets, like bonds from emerging markets, and buy ultra-safe assets, like United States Treasury bonds. LTCM was positioned for this exact scenario, but something unexpected happened. The crisis was so severe that it triggered what's known as a flight to liquidity. This is a subtle but crucial difference. A flight to quality is about seeking safety. A flight to liquidity is about seeking cash at any cost. Investors were so scared that they started selling everything they could, including the super safe assets they were supposed to be buying. They just wanted out. They needed cold, hard cash. As a result, the price gaps, or spreads that LTCM was betting would shrink, suddenly started to widen dramatically. Imagine our Apple example again. In a panic, maybe the price of the $1 apple drops to 90 cents, and the price of the $1.01 apple drops to 95 cents. The spread didn't close, it widened from 1 cent to 5 cents. For LTCM, this meant their trades were now losing money. For the first time, the fund posted a loss. It wasn't huge, but it was a crack in the armor of invincibility. The partners, however, remained confident. They saw it as a temporary anomaly. Their models said the spreads would eventually return to normal, so they doubled down on their bets. Then came August of 1998. This was the moment the world changed for LTCM. The Russian government, struggling with its own economic crisis, did the unthinkable. It defaulted on its domestic debt. This was a bombshell. Financial models all over the world, including LTCM's, had considered a Russian default to be a highly improbable event. It was like a Six Sigma event, something the models predicted might happen once in the lifetime of the universe. The Russian default threw gasoline on the fire that the Asian crisis had started. It triggered a global panic of epic proportions. The flight to liquidity went into hyperdrive. Investors didn't just walk away from risk, they sprinted. They dumped everything that wasn't a US Treasury bond. Spreads across every single market blew out to levels never seen before. It didn't matter if it was a Danish mortgage bond or a Brazilian government bond. If it wasn't the most liquid, most trusted asset on Earth, it was being sold. For LTCM, this was the perfect storm. Remember, their entire strategy was based on the idea that while one or two of their trades might go wrong, thousands of them, spread across different markets, couldn't possibly all go wrong at the same time. The models showed that the movements of, say, Italian bonds and US corporate debt were not perfectly correlated. But in the panic of August 1998, they were. Everything became correlated to one thing: fear. Think of it this way. Imagine you're a casino owner and you've designed a game based on 100 different roulette wheels. You've analyzed them and know that, on average, the results are independent. It's highly unlikely that all 100 wheels will land on red at the same time. You've built your entire business on this statistical independence. Then one day, a massive earthquake tilts the entire casino floor. And every single ball on every single wheel slides into the red pocket. That is what happened to LTCM. Every single one of their meticulously calculated, scientifically backed trades went into the red, all at once. The losses were catastrophic and terrifyingly fast. They were losing hundreds of millions of dollars every single day. One day in late August, the fund lost $550 million. That's more than $500 million in a single day. In less than 4 weeks, from late August to mid-September, LTCM lost $1.8 billion. By this point, the fund had lost nearly all of its capital, the money that belonged to Meriwether, his partners, and his investors. This is where the story goes from a private company's failure to a global emergency. The problem was the leverage. LTCM hadn't just lost its own $4 billion. It was sitting on a mountain of assets worth well over $100 billion and had off-balance sheet derivative positions with a notional value of over $1.25 trillion. Yes, trillion with a T. All of this was financed with borrowed money from every major bank on Wall Street: Goldman Sachs, Merrill Lynch, JP Morgan, you name it. If LTCM went bankrupt, it wouldn't be able to pay back its loans. The banks would then be forced to seize LTCM's assets, all those Italian bonds, Danish mortgages, and other exotic securities, and sell them on the open market to get their money back. But here's the terrifying part. Since all the banks knew LTCM's general strategy, many of them had been making the same kinds of trades. If they all tried to sell the same illiquid assets at the same time, it would trigger a fire sale, crashing prices to zero and causing massive losses for the banks themselves. It would be a domino effect that could freeze credit markets and plunge the global economy into a deep recession. The Federal Reserve, America's central bank, saw this coming and realized it had to act. The president of the New York Fed, William McDonough, summoned the heads of all the major Wall Street banks to a meeting on September 23, 1998. He basically locked them in a room and laid out the grim situation. He told them that LTCM was a loaded gun pointed at the heart of the global financial system, and it was their problem to solve. He made it clear that the Fed would not use public money for a bailout, but he encouraged them, with all the authority of the central bank, to come up with a private solution to save themselves. The negotiations were incredibly tense. These bank CEOs were fierce rivals who would normally do anything to see a competitor fail. But now, they were being told they had to band together to save one of their biggest clients, a client whose arrogance and secrecy had put them all in this position. After a long, agonizing weekend of brinkmanship, they finally agreed. A consortium of 14 banks and brokerage firms ponied up $3.65 billion to recapitalize the fund. In exchange, they took control of 90% of LTCM. The geniuses Meriwether, Merton, and Scholes were effectively wiped out, losing their personal fortunes and, more importantly, control of their creation. Their grand experiment had failed. So, what are the lessons here? This story is so much more than a historical curiosity. It's a timeless fable about finance, human nature, and risk. The first and most obvious lesson is about the danger of intellectual arrogance or hubris. The partners at LTCM were brilliant, but they allowed their brilliance to blind them. They believed their models were a perfect reflection of reality, failing to appreciate that models are by definition simplifications. They couldn't capture the raw, unpredictable, and often irrational panic of human beings in a crisis. They thought they were smarter than the market, and the market taught them a very painful lesson in humility. The second lesson is that your models are only as good as their assumptions. LTCM's models were built on historical data. They assumed that the future would look more or less like the past. But history doesn't always repeat itself. Sometimes something happens that has never happened before. An event that is so far outside the bounds of normal expectations that it breaks the model completely. The writer Nassim Nicholas Taleb would later popularize a term for this: a black swan event. The Russian default was a classic black swan, and it revealed the fatal flaw in relying too heavily on the past to predict the future. Third, we have the brutal lesson of leverage. Leverage is like financial cocaine. It feels amazing on the way up, but it can kill you on the way down. LTCM's extreme leverage meant they had no room for error. A small percentage loss on their massive asset base was enough to wipe out 100% of their own capital. It turned what might have been a survivable loss into a fatal one. It's a reminder that managing your downside risk is often far more important than chasing maximum upside returns. Fourth, there's the critical concept of liquidity risk. LTCM might have ultimately been right. Had they been able to hold on to their positions for another 6 months or a year, many of those spreads probably would have converged back to normal, and they would have made their money back. But they couldn't hold on. They ran out of cash to meet their margin calls. A margin call is when your lender, seeing the value of your collateral fall, demands you put up more cash immediately. If you can't, they forcibly sell your assets at the current terrible prices. LTCM was proven wrong because they ran out of time and money. The famous saying in trading is, "The market can remain irrational longer than you can remain solvent." LTCM is the ultimate proof of that statement. Finally, the story of LTCM introduced the world to the modern concept of systemic risk. It showed how the failure of one highly interconnected and leveraged firm could threaten the stability of the entire system. The term "too big to fail" entered the popular lexicon. The bailout, even though it was private, set a powerful precedent. It sent a message that if a financial institution gets large and interconnected enough, the authorities, one way or another, will not allow it to collapse in a disorderly way. The legacy of long-term capital management is profound. It's a case study taught in every business school and a cautionary tale whispered on every trading floor. It starkly illustrates the eternal conflict between the desire for mathematical certainty and the reality of a messy, unpredictable world. And perhaps the most chilling part of the story is that just 10 years later, in 2008, the world would face an even bigger crisis rooted in the very same issues: extreme leverage, complex and misunderstood financial instruments, models that failed to predict a black swan event in the housing market, and a systemic crisis that required a massive government bailout. The geniuses at LTCM provided the world with a clear, unambiguous warning. The story of their failure was a dress rehearsal for an even bigger drama. It serves as a stark reminder that in the world of finance, the graveyard is filled with geniuses who forgot one simple rule: no matter how smart you are, you must always respect the power of the market.